begin the Q&A portion, and we'll just jump right into the very first question. First question comes from Daniel. Daniel asks, could Naspers exit their 10-cent position without consulting shareholders?
Yes. In fact, they're selling and trimming their position strategically, and they're using the collateral or their cash that they obtain to buy back stock, which will actually force the gap to close over a long period of time. So they don't need to check with shareholders. They do periodically send out an announcement where they'll say, we're going to trim. It's really Prosus who's doing the trimming. Prosus will trim, and they might announce that they'll trim 2% over the next year or so of their 10-cent position. It is a enormously dominant position in their portfolio. Essentially, for a small bit of background, in the very late 90s, Naspers was exiting China entirely, and they found a small company called Tencent, and they were able to basically purchase with $20 million, they were able to purchase about a third of the company. And as that company has completely grown through WeChat and all of its many, many subsidiaries, it has basically appreciated now toward a valuation approaching $1 trillion. And it literally was breaking the Johannesburg Exchange, because this small South African private investment vehicle was essentially publicly traded and became like a 25% of the whole Johannesburg market. So they did all of these steps to move some of that they moved Prosus to Europe, and Prosus is actually what holds the Tencent shares. And so they announced strategic sales of their Tencent stock. They are trimming it slightly over time, and then they're using that cash to buy back stock. So they don't need to check with shareholders. We monitor it carefully. We've shown over the years that it's slowly been on a little bit of decline, but the Tencent stock itself is doing quite well. And so we continue to hold that position. And I think, as I mentioned, we were buying it in the 20s. Now it's in the 60s. We see the value can pretty much by 2030, maybe it will be over 100, 120. So we like the holding very much.
Great, thank you. Our next question comes from Ed, and he wants to know what your thoughts are on the recent software capitalization publicity with DJCO, and gave a little bit background too. For some background, there's been legal action against DJCO regarding their accounting, as they tend to expense software development costs. A firm has claimed this is an incorrect method of accounting, expecting instead for it to be capitalized and depreciated over time. However, DJCO claim they are correct, and they've confirmed this with outside audit. Matt?
Yes, this is true. It's a fictitious claim designed to be a publicity stunt by the intruder. So although it's a slight distraction for some of the management team, some of us included, we completely side with the business. Essentially, there's some very fine details where this outside firm, who owns no shares and has no vested interest in the success of the firm, is, for publicity purposes, claiming that they should be capitalizing their software expense rather than expensing their software. That is not correct. And there's been statements made by Stephen Myhill-Jones and management, letters that have been publicly addressing this, and an outside consulting firm that's agreeing. And ultimately, what the outsider is attempting to is asking them to capitalize rather than expensing their development costs simply means that they're going to take the cost that they spend on developing software today and spread it out over the next decade, which then reduces their costs or expenses on their income statement temporarily, and by the way, they did spend the money. So they're going to spread out the expense over some period of time into the future, thus artificially increasing their short-term profits, which incidentally would require them to pay additional cash flow in things like taxes and things, but artificially increasing the profits because they're spreading out the costs into the future, which then will supposedly drive the stock price up. So this is a very short-term thinker, and the approach is being done for publicity. So we're trying to just steer clear. And I expect these firms, we have some really great, interesting firms. Some of them are extremely unique. They're going to be dealing with some outside attacks from time to time. Unfortunately, we're dealing with this one from Daily Journal now. It doesn't have any merit. Unfortunately, the individual is just making a mistake. So hopefully he stops. In fact, he's asking in his claims for, I think, $24 million or something for discovering this anomaly. So that, I mean, it's very much in his self-interest. There's nothing, the firm is a wonderful firm. Obviously, Charlie Munger and everybody at the helm are doing things properly. Steve Myhill-Jones is excellent. Jennifer, you may have met him. He was at our Berkshire soiree this last year. And so we are really confident with the management team, the board, and the direction that everybody's headed. And we're very happy to have them expensing these technology costs as they spend the money to develop the technology. It makes a lot of sense the way that they're doing things, and the outsider is incorrect.
I do remember meeting him. Very brief conversation, but yeah, I was a nice guy. Our next question comes from Marco. Do you see any risk or downside in owning just the Alibaba ADR for the long term?
Well, the most common risk that you're probably referring to, Marco, and it's great to have you here, is like a delisting risk or something of that concern. It sounds like that might be the focus. Essentially, if any of that actually occurred, and none of that really will materialize, it's a very, very unlikely probability in the long term, but it's still like a headline threat. We would actually just end up with the Hong Kong share, and it's not like they would just be erased or eliminated. So I'm very comfortable holding the BABA ADRs. A lot of other investors are holding the BABA ADRs as well. And in fact, if you look at 13Fs, there seems to be a massive uptick in demand right now for the BABA ADRs. Even in the options market, people seem to be buying up a lot of calls and things. I think Michael Burry just sold his short puts in stock and went all in on calls. I think a lot of people are very interested in Baba. I'm a real fundamental believer in the success of Alibaba. They are a global firm, and their market cap is like, 1/10 the US equivalents. And so that gap may exist for a while. I don't expect that China's risk profile will completely dissipate, but over the next decade or so, it will materially close. And Alibaba is not just earning income out of China. They have cloud, they have AI, they have some of the best AI tools in the world. So Alibaba is a real strong performer. There's great potential. Jenny's been hearing me talk about it for, I think, a year now. So I'm very fond of it, and I'm not concerned about holding the ADRs. It would be very disruptive to the capital markets to have the US and China be fighting over which companies are going to be listed and delisted. And if that ever were the case, they would be transferred into the Hong Kong shares. So I'm not worried about losing value if they were delisted.
Great, thank you. And as a reminder, if you have a question, go ahead and type it into the group chat, or if you wish to stay anonymous, you can send your question over to Tamana. The next question comes from Nolan. Nolan asks, is the Titan Strategic Income Service available to individuals who are not yet Peterson Capital Management partners?
Yes, it is. Thank you, Nolan, for asking. So we're very excited. In fact, that's one of the reasons that we're spinning it out. We have so many outside requests we've been running structured dividend capture in our Peterson Capital Management internally now for many years, for I think 4 or 5 years. And individuals and firms and family offices have come to us asking for direct exposure. And, they maybe didn't want Daily Journal exposure or Alibaba exposure. And prior, we didn't have any, real vehicle to provide. And I was fortunate enough to meet Nikhil almost a year ago now. We are both members of a group we call that's called the Capital Alliance. And we meet this mastermind of financial professionals meets about 3 times a year. And it's very rare for me to come across somebody who's as mathematically and technologically gifted as Nikhil. People come and talk to me about structured dividend capture all the time, and oftentimes they're missing something. Nikhil came to me with additional insights, things that he's discovered. It just doesn't happen. So it was a really nice natural fit. Nikhil and I got to know each other over the course of many months. and started working together and collaborating on this. Nikhil has actually recently published a book. So if anybody wants to learn more about these strategies, I highly encourage you to reach out to Nikhil. I think it's an ebook that's even available for download. So I'm very excited, Nolan, for the fund. That's going to partly Nikhil's going to do a better job than I could do. When I was running it myself, I'm placing orders and doing things on the weekends. I'm trying to do it outside of market hours. It's really obvious to us that if we have a daily focus and look at the profit maximization capabilities after a market close or in the mornings during a day, we can really expand this. And there's a lot of opportunity. It's not that small of a space. I mean, everybody's afraid what happens when you get to $1 billion, and we'll deal with that when we have $1 billion AUM. But with 100 million or 150, 200 million, we can run this Titan fund very effectively. So Nolan, we'd love to have you involved. We're opening it up to everybody October 1st, and we'll reach out, and you can reach out to us after the meeting. We can set up some calls. Thank you, Nolan.
Our next question comes from Matthew. Matthew says he saw PayPal on an earlier slide. Is Peterson employing structured value on PayPal?
We are not currently. So PayPal showed up because it was at the intersection of 13Fs and Veritas Alpha. So, and that intersection is so interesting to us because we have certain metrics that over the years we've actually automated now, and we, on a quarterly basis, prioritize all of our research within 13F. So let me share with you why it's there, and also why we're not. Basically, we are fully invested. So Matthew, thanks for the great question. Our capital's really fully invested. I mean, we have almost 30 million AUM. We have $1 million that we're going to put into Titan on October 1st, and everything is already invested in these long-term compounders. So frankly, we have way more ideas than capital. If you are interested in participating, we have tons of opportunities. So please reach out to us with your interest. The reason that PayPal is showing up there is because it appears on the 13Fs. PayPal is owned by some of these wonderful value investors around the world. We follow these 13Fs very carefully. And what we found that's interesting is that even though there's small movements in time inside of these portfolios, the overall scope of these businesses is really stable. So there are a lot of firms that are held by a couple of multiple managers, and even if one sells out, the other's still holding. So this superset of what's in the 13Fs is like 400 to 500 companies, and there's maybe 10% turnover per year. It's really remarkable. So PayPal shows up very high on our internal metrics and how we score the 13F research priority. In addition, if you run the total market analysis on the Veritas Alpha page, what that does is it gives a page-by-page snapshot of every company in the US. It's totally mind-blowing. If you can imagine, I don't think people would even consider doing this before AI existed, and I don't know that anybody's done this yet. I mean, we are doing it first. So what we've done is we're taking in 20 years of very important fundamental data. We're capturing all that data. We're displaying in a really comprehensive way that we can understand. It's very simple, the way that we've positioned it, with all of these diagrams and things that just show the multiples expanding and compressing against themselves. It's like relative to itself, how cheap or expensive is this firm? Has it been more expensive relative to the earnings that it made in the past? Has it been less expensive in the past? PayPal is a very inexpensive company, and it ranks very high within our Veritas Alpha total market ranking. So by looking at the 13Fs, which have 500 firms, and then comparing it to the fundamentals that we're looking at veritasalpha.com, we just quickly throw up 10 companies, which include PayPal on that screen I just showed you. And we're just doing that out of, I don't know, favor, interest. If you want to go look at some companies, here look like some pretty good ones. And we made this slide last week based on the analysis. And we found it kind of interesting that 2 days ago, Warren Buffett announced that out of our 10, he's buying 2 of them secretly over the last quarter. So I think that probably, without too much detail, you will probably do just fine if you were to buy PayPal. And I would think that you'd probably do just fine and pretty well if you were to sell a cash secured put on PayPal, because there's going to be a lot of price pressure pushing it up. You're probably going to keep that premium. And so we do not have any exposure to PayPal. That's just one company I threw out there that might be of interest. We're not telling anybody to go buy anything. Do your own research, but it's showing up very at a high place on through some of our different fundamental research.
Our next question comes from Amit. Amit asks, can you provide an update on the investment in Dhandho
Yes,
Fund
Dhandho
and
Holdings.
outline what this has specifically invested in? What risks are associated with the investments?
Yes, it's a great question. So we had an opportunity over 10 years ago now to buy a piece of Monish Pabrai's investment holding company, Dhandho Holdings. And that was a really nice opportunity at the time. It was a very rare situation. We had a small amount of capital. We only had 5 million AUM. And I think the requirement was a $2 million investment. So we made a bit large investment. And that Dhandho Holdings entity has gone through a lot of different paths to get to today. Purchased an insurance company, tried to do a roll-up of insurance companies, ended up unwinding that due to some unprofitability measures and challenges in getting the combined ratio under one. Ultimately, owned a few different pieces, but primarily they started paying us back dividends as they started selling, actually a return of capital. And so the investment itself is actually quite small now in our portfolio. I think it makes up about 2% of our capital position. So it's a really small company, but we still own 2 or 3% of the entire Dhandho Holdings. And what Pabrai, and this has led to all sorts of positive things, like just having a better, stronger relationship with the firm, with being involved in a lot of the discussions with Pabrai himself, who many of you may know to be this legendary investor, friends with the late Charlie Munger and Warren Buffett and all the others. Notably, I think had won one of these original lunches or purchased one of the original lunches with Buffett with his friend Guy Spear. And so what they did most recently is they launched the Wagon Wheels Fund. Some of you may be familiar with the Wagon Wheels Fund. That is inside Dhandho Holdings. So interestingly, as that fund is gaining traction, as that fund is gaining in AUM, we will benefit as the Dhandho Holdings owners for that fund's success. So there are a few small holdings still within. I think Racehorse being one of them. There's a small private investment that Pabrai has made, and then Dhandho Holdings has now focused on, and Fahad and the team there with Pabrai are focused on building out the long-term business within the Wagon Wheels Fund. And so that is the new catalyst behind the growth in future growth in Dhandho Holdings.
Great, thank you. Our next question comes from Digby. Digby asks, are you considering other jurisdictions aside from the US and Turkey based on country reports available on Veritas Alpha? If so, what filter replaces the 13F filings as a starting point for securities in these other jurisdictions?
Yes, Digby, welcome. Great to see you here. So mostly we are opening up jurisdictions where we have the capability and there's a lot of low-hanging fruit. So we have so many things that we can do. We're trying to figure out what we should do and prioritize all the different efforts. And Yakun and George do an absolutely wonderful job of that. We had some meetings with some folks in India, so we turned on India. By the way, we don't always have a 13F equivalent in different countries. So, some of that comes from our partners and things. They come and tell us, this is how we could do it in Singapore. But what we can do often is get the public market data. So we picked up the public market data through India, and now you can not only, it's really impressive, you can not only run the total market insights report for India, but you can actually go in with Indian tickers. If you reset the region, you can order any public company an analyst report for India. There's 4,000 companies that are showing up on our list as publicly traded, where there's data, quality data available. And so you can go in and you can ask for Infosys and everything else that you want in India, and it is going to, in 20 minutes, produce a investment quality report and send it right to your inbox. So as we discover and find 13F capabilities, we would love to incorporate it, but not every country has reliable data. So we do the total market insights report for Turkey. We made one for the UK. We made one for Japan, since there's all these interested investors in Japan. And we sort of just went down the list, and each one takes a day or two for Young Kun to get set up and some of the other developers to work on. So it's all about just prioritizing research. If there's a specific region that you'd like to see, please just reach out, let me know. We can definitely try to turn something on. It would be helpful if you know where we're going to get the data. Otherwise, we have to figure it out. But if you have some insights, we can just really just flip on the switch. And maybe there's 220 companies in the world. It would be incredible if we could just incorporate all of them. And I think that we should be able to. I mean, right now, in 20 minutes, we can do the analysis on 6,500 companies in the US. It's mind-blowing. And then in the same 20 minutes, we can do 4,000 companies in India. So this is like earnings can come out, earnings season can happen, and we can run all these reports, and they run in parallel, and then we can cross-analyze against the reports. So Digby, just please, reach out and let us know your requests. I'll tell you, we get a lot of various requests, and part of our job is just to prioritize what we're going to work on next.
The next question is also another Veritas Alpha question. This comes from Mahendra. Mahendra asks, regarding the data source of Veritas Alpha, how does the tool ensure it's consuming the correct inputs and not information from another blogger or YouTube post?
Yes, we have gone through great lengths to ensure the reliability of the data and reports. And that doesn't mean that there are no hallucinations or no errors. In fact, we find that like 1 out of 10 reports can just even skip a section that it's supposed to include. And we anticipate that as these LLMs improve, and they're improving all the time, it's a highly competitive market. Some of you are seeing what's happening between OpenAI with ChatGPT and Gemini versus Claude versus all of the other tools that are available. They are all neck and neck trying to get better and more results. So ChatGPT 5.0, ChatGPT 5 was just released. So how should I start? Let me start with this. We have started internal metadata flagging system so that we know which data sets are part of our tier 1, tier 2, tier 3 inputs. So as a equity analyst, part of the job is to consume just an enormous amount of data and not overlook anything, but also the human judgment has to determine its own reliability. So how does a human judge whether or not a Twitter post is reliable or accurate? That's sort of what we're trying to understand. And so what we do is in our tier 1, by the way, to generate one of these reports, there are thousands of pages consumed. So in tier 1, we're going and looking at 10Ks, 10Qs, earnings transcripts, and oftentimes for many years. So, you might have, there's actually a references page beyond the valuation section in each report. And you'll see that probably around page 50. And what it will show you is that it has consumed, say, 12 10Qs, 5 10Ks, 15 earnings call transcripts, fundamental data from Yahoo Finance, financial modeling, prep, et cetera, et cetera. That type of hard data we classify as tier 1 data. We assume that it's reliable and correct. It's publicly recorded data by the company, and it's in places. It's coming directly from the SEC. So we are going right to the SEC through their API. So we're not working around trying to scrape and this kind of stuff. We are actually going through the APIs of these different systems and consuming the highest quality data we can find. And so that data we call and classify as tier 1 data. Now, what's tier 2 data? Tier 2 data for us is like an additional analyst report and even our last analyst report. So I find this, George and Yankun and I have been strategizing on this for some time. How do we eliminate hallucinations and get the most accurate reports we possibly can? What we've decided is that we can round robin our LLMs because we could run them on all the LLMs. At some point, we'll set up a pro and tier version and probably charge quite a bit, 10,000 a month or something for these reports. But the basics are that if you have one LLM producing a report and then you switch it over to Gemini, let's say you have ChatGPT and then you have Gemini produce the report. If you feed in your example report from ChatGPT, it very quickly pulls out all of the errors and mistakes, identifies them for us. So basically what we're doing is we're archiving every report that anyone orders. So you get the report and then it also sits in our AWS cloud. And once that's sitting in the AWS cloud, the next quarter we round robin and switch the LLM. So right now we're using Gemini to produce these reports. Last quarter we were using ChatGPT. But the Gemini reports are taking the last ChatGPT reports. That is a tier 2 report. Okay, there are potential mistakes in that report. And that report then gets refined and corrected. And Tamana has done some incredible analysis comparing our ChatGPT versus ChatGPT plus Gemini and has found drastic improvements. It doesn't mean that that Gemini would do better without the report. It means that with the incoming tier 2 analysis, Gemini can improve on the analysis. So each quarter, these reports will be better and better. And they're compounding. I mean, after a year of this, I think we will essentially eliminate the mistakes and we will have everything up to date. Mistakes being things like the report might start talking about Q2 2025, and then in a new section on a new page, say in the SWOT analysis, it'll just put a data point from like 2022 that doesn't really make a lot of sense. If you were a real analyst, it just kind of jumps back a couple of years. That kind of stuff is going to go away. When we first were making these reports, by the way, it could hardly do math. You might remember it couldn't count R's in strawberry, like all this sort of stuff. We just kept pushing forward because we knew the LLM models were going to catch up. We know, I am very confident that large language model and the AGI that is on the horizon will be dominant to human analysis. I'm very confident. There's no way that a human can consume this amount of information and take as comprehensive a look at everything as our AI system can, and pretty soon as any AI system probably can. And so as I see this coming on the horizon, and it's like very soon, 6 months, 9 months, I think very soon you won't want to trust an advisor or a fund manager who's not using AI. AI will provide the guardrails, just like people are right now probably fearful about what happens with autonomous vehicles and driving. I think in the long term, go out 10 years, you'll be scared of the human behind the wheel versus an AI behind the wheel. So we are tier 3 inputs start to become social media posts from regular, perhaps retail investors. So how do you determine, and by the way, we've also incorporated a comments post, because what we need to do is have positive feedback loops or any feedback loops inside the reports. I can't possibly scrutinize 6,500 of these reports, but our users can. So if you go in and order a report and find a problem, you can actually write a comment and assign it to that report. That report gets stored and that becomes a tier 3 question, an input for the next LLM creating the next analyst report. So that input that you write will be considered by the LLM and potentially included in the next report. So I'll give you one last example. I'm sorry to keep going here, checking the time. I had this interaction with Stephen Michael Jones, CEO of Daily Journal, That was, somewhat amusing. I wouldn't say it's embarrassing, but unfortunately it wasn't successful. I was showing off our Veritas Alpha page and I said, order a company. And so of course he orders Daily Journal. It's often what people do. Management tend to order their own companies and then they order their competitors. I've actually talked to some private business owners about it who then order their public business competitors and get great insights into what their competition is doing. So there's many uses for this analysis. When Stephen ordered the report, of course, he received the Daily Journal report, and it took 20 minutes. We were no longer at the time together, and he emailed me later and said something like, "Nice tool. I didn't really get it right." And so I went and checked the Daily Journal report, and it's all about the traditional newspaper business. It totally misses the software aspect. So we need, and that's part of the reason that we found this company. It's people, and even the LLM doesn't realize that the powerful engine underlying Daily Journal is Journal Technologies. So even the LLM missed it. And so we need a way to feed some pieces of information to help the LLM get the traction it deserves. So that becomes like a tier 3 resource. We store those pages in AWS. We'll store your comments to the reports in AWS. And ultimately, I believe these reports will become the standard. I mean, we can't do it in any other way at this point. And we're really pushing the limits. It seems very promising, but let us know if you have solutions to these challenges.
Well, and Matt, just a really quick follow-up from Amit regarding this. So, are you just using Google Gemini and OpenAI's ChatGPT, or are there any intentions on using Anthropic's Claude or Grok to generate reports too?
Yes, absolutely. We're deciding whether on October 1st, we're going to switch to either the Anthropic. We always use the pro versions and we're using the reasoning versions and things of that nature. So Sonnet Opus 4, I think, is the latest Anthropic version, although I know the team here just did an AI class, maybe someone could tell me. But I think Anthropic's latest Opus version, and now they have their finance capability. So that is something we will try to switch to the best tool at the time. So we'll either go to Anthropic, and we've also discussed Grok. So those two are kind of lead contenders for the next round robin model. And then we will feed in this ChatGPT report from Q2. We will feed in the ChatGPT or the Gemini report from Q3. And then we will have Anthropic or Grok create the report for Q4. And we will then probably end up back with ChatGPT 5 in January, and we will continue to move these models around. And if we ever, when really, I mean, ultimately, we'll ultimately put logins. Our partners are going to have access for free, but we should have some institutional interest. And when we get to that level, we'll probably have the capability of running multiple reports on multiple LLMs simultaneously, and then building up from there. And Amit, I'll tell you, I mean, we have so many plans, but you can imagine, I'll just help you all also, everyone on the call. We have, first of all, you can run a whole industry, which is amazing. And ultimately, once the industries are run and everything's stored in AWS, we will be able to build cross-industry analysis. And then we can also compare across the industry. So we're just going to be able to do everything. That was so impossible. The scale is so large. And imagine we could do it in India, or imagine we could do it in Japan. We don't even need to speak Japanese. We can go in there, we can read any report in any language in 20 minutes. We can have it in any language we want. And we can look across all the industries. We can find the cheapest industry, the fastest growing industry, and then we can find the company within that industry we want to own. So this is like an incredible tool. And the way that I often like to use it is I generate a few reports that are of interest at that moment. And then I put them into my own LLM, my own favorite LLM. So you can just upload them. I don't have any problem. Like you're going to get a link, just download them. Then you upload them to your ChatGPT. And if you sit there and you say, okay, here's Nike, here's Lululemon, here's Under Armour, it's going to tell you Lululemon's the cheapest. That's just what it's going to do. So you can just start asking questions, and it's like you're talking to bunch of senior analysts who have studied the systems. And without the reports and data right there, you'll get too many hallucinations. So uploading that report is helpful. So you order the report, upload it to your LLM, start asking questions, and you'll get some really refined, great answers.
Great. Moving on, someone asks, can you go over the fee structure for the Titan Fund for both existing PCM LPs and prospective LPs?
Yes, absolutely. The fee structure completely mirrors the Peterson fee structure. So in fact, we have designed it with operations they're just totally aligned and exactly the same. So the fee structure is as follows. There is a zero management fee for any partner that has 2 million or more in the fund. And that's across all of these, including Talas. I mean, there's zero management fee. We have an exception class for those who have between 250,000 and 2 million in any of these funds. I think Talas actually has zero all the way to the bottom. There's zero management fee at Talas. That's very unique. We have an exception class for Titan and Peterson, 250,000 to 2 million. There's a very small 0.9% management fee. Okay, 0.9% is like less than a financial advisor charges to go find a fund to put your money in. So that helps us keep the lights on a little bit, but you can imagine zero management fee, 2 million and up. I mean, we don't get paid at all for anything. We have to make returns to earn any income. So we have zero management fee. We have a 5% hurdle rate, means we never charge on anything under 5%. Every year at January 1st, it starts over. If we don't hit 5%, we get paid nothing. Titan's the same, Peterson's the same, Talas is the same. You get nothing. So after and above 5%, we share in the upside for that year. 75% goes to the LP, 25% goes to the entity, Peterson Capital Management, Talas Capital, Titan Capital. Okay, so that's the general fee structure. We also have high hurdle rates, high water marks. We have a hurdle rate. Our hurdle rate's 5%. Our high water mark means if you're not at the highest point you've ever been, we don't charge anything. You have to be hitting new highs and you have to be going over your hurdle rate. So this totally aligns everything. This is based on the original Buffett partnerships, by the way. So this puts total alignment. I mean, we don't want to go down. And we've had down years for sure. And actually, it's probably maybe some of you that can read through the lines. It's nice to see that when we go down, we don't just shut funds, because that is a unfortunate practice by some managers. When you go down in a year, the whole next year you're climbing back up to your high watermark. You're not getting paid. I mean, we don't make anything that year. So we are really conscious of downside protection. We are not looking for opportunities to make 3, 4, 5%, because that does nothing for either our partners or us. So we're really looking for great long-term compounding opportunities. So to summarize it all, I know it's a little bit complicated, but we basically have a hurdle rate of 5%. We have zero management fees, a hurdle rate of 5%. And then we have a performance fee above 5%, 25% of the gains above that. Okay, so if we have a 9% year, Peterson Capital Management or Talas Capital or Titan Capital or Talas Capital will earn 1% of the 4% above 5. We also have high watermarks in place. And if you look around at a lot of funds, I think Guy Spears, CFO, years ago wrote the article with whom I would invest. And they looked around for fee structures of this nature. And we ended up with Talas and Peterson. They found, I think, 40 funds in the world. So there are like thousands of funds, 40 funds in the world. And there's only a few of them that are truly aligned with their investors in the way that Warren Buffett and everybody else has taught us. So hopefully that's helpful. I know it's a mouthful and it's a little complicated, but we're not doing 2 and 20, which is like the old standard method. This is zero, a high watermark, a hurdle rate, and then we share in the upside only above the hurdle rate. And every January 1st, we start again at 0, and we have to hit that hurdle rate again. Thanks for the question.
Great. We're almost getting to the top of the hour, so we have time for maybe 2 or 3 more questions. Our next question comes from David, and David says, if I'm right, I saw that the Peterson fund performance has been lagging SPY's performance for a quite long time. Any thoughts on that?
Yes. So few thoughts on that. I don't want to dismiss it because basically the S&P since inception has returned like 15% with dividends included. So that was a very early slide, and it's in all of our reports as well. So I can share a couple of thoughts. First of all, the S&P's long-term record is 6.8% plus inflation. Now, if you include inflation in those numbers, that's where people sometimes get to the 9 or 10% range. We are showing those numbers with absolutely zero fees, zero expenses. That is the absolute maximum that an investor would get if they put all of their capital in the S&P 500. Since inception of our fund, the S&P has been in this crazy long bull market. So the S&P is at 15% annualized. We are currently at 11.5% annualized. The challenge is that we're doing it safely. And we, by the way, we don't match the S&P. We're not like closet indexers. So we are doing this very strategically with a very concentrated portfolio. And it may take a little while, but I'm still confident that we are going to end up in the long term beating the S&P. Because from this starting point, and I don't want to alarm anybody, and the market can still continue to climb for some time, but we're going to have a major correction and possibly recession at some point, potentially even within maybe the Trump administration, like in 2 or 3 years. And we can't time it, but there are companies out there that are very expensive. And so the markets are kind of in a later stage, and there's a little bit of euphoria. People are pretty happy with the way that their 401ks have returned, and a lot of maybe they're just owning the index. So the challenge is, if you own the index now from this level, what has to happen to get to that 6.8% plus inflation over the next decade is like a very low average return. So maybe a 3%. It doesn't need to crash. It doesn't have to crash, but it's very unlikely for the S&P to continue growing at double-digit returns for the next decade. It's much more likely that we have some corrections, and corrections happen quite frequently every few years. So correction wouldn't be that abnormal, but I wouldn't be surprised if the markets had not moved that much higher, at least not at this speed, into 2030 and 2035. So our positions are really well diversified all over the world. We even have, as mentioned, our like private holdings of Dhandho. We're doing some pretty unique things, and our positions will, like Daily Journal, a market crash won't have any long-term impact, the trajectory of where that business is headed. So even though we are still lagging, we just keep swimming. As Charlie Munger said, sometimes the tide will be with you, sometimes against you. You just keep swimming either way. So we're actually pleased to have 11.5%. I think it can be a little higher. I will point out, we went through a hard time from like 2014 to 2019. We had a couple of difficult years. We had a stagnant position with our Dhandho Holdings, for example, because it was a private holding. We just hold it at book value, and they were spending money to build the business. And so with 40% of our capital invested, we were just kind of like slowly losing money. And then we also had a big misstep with a fraud, which was the Horsehead Holdings, some of you may recall. So we went through some challenging times that held us back a little bit. But I think from 2018 and 2019, I mean, we're doing very well, and we're always, every year we're just getting better and better. So I'm pretty confident that we're going to be able to outperform over the next decade. And 11.5% is not a terrible return. I think, net to investors, I think people are up 350% or so over the last almost 14 years, which isn't terrible. It's actually pretty decent, pretty reasonable. So I think that will continue. I think we can continue our double-digit growth, and I think the S&P's growth will slow considerably over the next decade.
Great. Our next question comes from Amit, and Amit wants to know now that Buffett is no longer with Berkshire, how do you expect Ted Weschler and Todd Coombs to perform as portfolio managers?
Yeah, that's interesting. So Ted and Todd are so there was a big announcement at the Berkshire meeting this year. For those who were in attendance, I think it was a kind of historic moment when Buffett announced that at year end, he will step down as CEO. Now he's going to remain chairman. I think in 2 weeks he turns 95, and so he's going to remain chairman. So Todd and Ted are really in the background. He's done a lot to protect their sort of sovereignty. So it's difficult. Some of you may know from like Caldides principles and things. It's difficult to be out there speaking publicly about your investment portfolio. So Buffett and Munger kind of mastered this practice, but they have protected Todd and Ted completely. Those two are managing enormous portfolios. I mean, I guess it was at least 7 billion, and that I think was each, and that was a few years ago. And now they're probably approaching 20. And of course, Berkshire has 340 billion in cash that's going to be managed by the entire executive team. I don't think that they'll have the same ability to attract the great deals, obviously, that Warren Buffett has done. And I'm not sure if I don't believe that they have outperformed the S&P since they joined. But as I mentioned, the S&P's on this like statistical anomaly. So I'm really confident in their capability. So I'm not concerned about Berkshire's holding at all. And so time will tell. It's hard for me to say. I think Todd and Ted are both excellent investors, and they're going to do, and they're great stewards of capital. They have this great fiduciary responsibility. Their blood runs with Berkshire. It's great to have them involved. Absolutely essential to have them involved. But it's a huge pile of money, and it's hard to put it all to work. So time will tell. And Buffett himself he's not leaving the board, and he's still alive. And the culture runs all through Berkshire. So even I think after he's gone, truly gone, and I do check the actuarial tables from time to time. I think he has 3 or 4 years left as a healthy 95-year-old. But when he's truly gone, I believe his estate is not going to be settled for 12 years, and he's holding his Berkshire. And then after that, there's going to be this period where he disseminates to all of these foundations, and then the foundations aren't going to immediately sell the Berkshire. So Buffett is a long-term holder. He's going to continue to be a long-term holder after he's gone. And Todd and Ted and everybody else in charge are going to be running the assets. And we're just lucky to have Buffett around right now. And I don't think things will change too drastically when he's gone.
We only have about 5 minutes left, but there are two more questions, and I want to be able to get through them. What do you think, Matt? Should we just try and go for the
Yes,
last two? Okay.
let's do it.
Okay.
And
David
if you
asked,
if you have other questions and things, you can all reach out independently. You can talk to anybody on the team. We love hearing from you all. So yes, Jennifer, let's.
okay, yeah, we'll fire through these two. David asks, in the sell put strategy, is Peterson Fund only selling cash secured put or selling vertical spread to get better capital efficiency?
Good question. I work through the things more mathematically, and then I try and figure out all these names and things. So I think a vertical spread is like selling a put at one price and then buying a put vertically at the same expiration date with a lower strike price, I believe. And if I'm wrong, you can clarify the question, David. But I believe so. There are situations where we could end up with that structure to some degree, but ultimately, when we're selling puts on a company, we're trying to buy the shares. And as the shares fall, we are totally happy to be buyers. And if they fell further, we wouldn't really want to suddenly have the stock pulled away from us. We wouldn't really want to buy those puts. Now, some vertical spreads maybe could work on, say, buying a long dated call on, say, Alibaba, and then selling a higher price call to help pay for that premium. And you can correct me if I'm getting this question wrong. And I don't think about it that way, but we can end up in that scenario if we've been put the stock and we're doing some tax loss harvesting. We might be selling short-term calls on the shares to capture the tax loss, but buying the 2.5-year calls simultaneously while the price is at a low. And in a way, and sometimes I've heard that called the diagonal. I don't know anymore what all these names are. So we can end up with some of that, but the framing is really simple. We are looking for opportunities where we can allocate capital to great companies that have great business models, that can compound for years, that have great management teams, that are selling for really low prices. And when we find those, we're just simply selling puts as a tool to get in below the market price. And we're not trying to get a lot more fancy. We are truly trying to build out a long-term compounding equity portfolio. And we're just using the structured tools available in the market to get in at better prices.
Okay, and last but not least, the last question is from Fen. Fen asks, could you please provide additional details about the Talas Fund, including its current performance and strategic outlook?
Absolutely, Fen. Thanks for asking. So Masoud El Tolu is on the call, and we launched this fund together. I'm here in Istanbul now, and so additional details. Well, so I've been coming to Turkey for about 20 years. My wife is Turkish, and Masoud and I met through Guy Spear at one of the ValueX events in Switzerland over 10 years ago, or maybe, yeah, probably 11 years ago now. And over a few years of meeting in Turkey, he was showing me all these different companies' opportunities, and they are truly outstanding. I mean, we're talking global brands, as he mentioned, companies that are maybe have their costs in lira, which is a highly inflationary market. There's a lot of inflation going on with the currency, and can be selling products globally. There's a company, Archlick, for example, that I enjoy because we get to go tour the factories, and they make all these washers and dryers and air conditioners, and then they sell them all over Europe for euros, but they manufacture them here in Turkey. So sometimes they refer to Turkey locally as like the China of Europe, because it's inexpensive to manufacture things here. So Talas has just been a great, so Talas, the fund, so Masoud is a true die-hard value investor, low turnover, concentrated portfolio. And the positions that we've had in Talas, some of them have been held since inception. I mean, most of them have been held since inception. And the Talas fund has totally crushed the Turkish market. And that's with like no turnover, no taxes. It's just these compounding companies. But the S&P's done extremely well. So it hasn't outperformed like the S&P. But these emerging markets, as some of you may know, are highly volatile and can be enormously lucrative at times. So I think Talas is going to Talas is going to have some wonderful years. I think there's been 50% years at Talas. And so Talas is doing quite well. It's managed very, very well. You can read all of the reports at talascapital.com. The passwords, you can request all the passwords. I don't want to just post it on YouTube, but I'll secretly tell you all it's Buffett. So you can log in and look at the reports. Masoud does a phenomenal job in putting all this data together. And we also do a Talas Turkey tour, which is like one of the most fun times of my year. We get one of these big Mercedes buses. I know a lot of you on the call have even come here. Digby was asked a question. We've been here with many of you. And so we go around from company to company. We talk to the executives, we talk to investor relations, we tour the factories, and we just get to see there's just outstanding assets here that are so mispriced, and we're just patiently waiting for them to be properly valued.
Well, that was the last question, so I think we can close the Q&A section. And I just wanted to thank everyone again for joining this year's annual meeting. As a reminder, Peterson Capital Management is launching another fund called Titan on October 1st for those interested in total strategic income. And we really do highly recommend or encourage folks to give veritasalpha.com a try and run these AI generated research reports. As someone mentioned in the group chat, it only took about a minute to get a report in his inbox, which is pretty remarkable. But Yan Kun on the team does point out that if a report has already been generated recently, it'll be sent out directly. But normally a new report takes about 20 minutes to be created. So this is quite a remarkable tool, and you all should check it out in your free time. So if you have any further questions about any of this, feel free to reach out to Matt or Mackenzie directly. Matt, if you have any final closing remarks you want to say to everyone, we can wrap up the call and call it a
Okay. Thank you. First of all, thank you, Jennifer,